if you're gonna be serious about trading, you gotta treat it like a business, right? And businesses carry insurance.
We all struggle to improve our options trading, and there are some key insights that we should have. My guest today is an electrical engineer by background. He went from retail trader to professional, and he even runs his own options trading fund. He also has the podcast The Trade Busters and is happy to share his knowledge and experience with other traders. So, welcome, David Sun.
Hey, John, glad to be here. Thanks for having me on.
Well, thank you for joining. Why don't you give us a very brief background about you as a trader?
Yeah, as you mentioned, I don't have a formal finance background. Started as a retail trader back in 08, 09. Really was dabbling in options. I had a friend at grad school who taught me about put selling. So did that with no real strategy, just pick stocks, pick a monthly option, and imagine that I can make 2 to 3% per month easily, right? Kind of the thing everyone fools themselves into believing at the beginning. But after a while, I found Tasty Trade in 2017, which gave me a little bit more mechanics and ideas to build off of. So I got my education, my learning curve that way. And then eventually I found my footing, got the confidence or maybe naivety to start a fund back in 2018. And did that, actually started a second fund in 2021. But it just been growing and along the way, learning more, building more strategies, doing more research. Started the podcast as a way to kind of have an educational outlet and connect with the retail community, which I always felt like I was still a part of, because I was learning from other people in Tasty Trade groups, Facebook groups. I think we might have met there, or I've seen you posting there before. Eventually started my Discord, started my podcast. So kind of happened this balance between doing the fund and also putting out content to kind of educate retail about options trading.
So this video interview is based on an excellent series you made in your podcast, The Trade Busters, and where you went through 4 principles basically for options trading. Why did you come up with these principles?
So for people who listen to my podcast, you find that it's kind of a mix of different ideas. There's some episodes that are trade strategy specific. Some of them are just my musings. Something happened and I had an idea I want to share. I even have guests come on. But what happened was we like to really think about, I wanted to focus on some ideas that were really core to my understanding of how to have trading success. And I named that series First Principles because it's really getting down to the essence. For example, the first principle was called Know Your Edge, right? And the reason for this is because trading is one of those activities where oftentimes the feedback you get from what you do is wrong. You will be rewarded for doing the wrong thing, or you might do the right thing, but you lose money or the trade doesn't work out. So it's hard to know how to navigate that, right? And so if you really go back, in order to know your edge, you always have to have some reason to make money. There has to be a business model or underlying principle why a strategy should be profitable. And so if you're making money when you shouldn't be, or you're losing money when you shouldn't be, that's basically, you're going to basically just go in circles and not have a know how to progress. And so edge can be from when you're doing options, selling options, we believe options are overpriced, right? The so-called volatility risk premium. And so that's one of the fundamental ideas upon which all options are selling. Option selling strategies are based. Now, that's not to mean you just sell options willy-nilly, don't have any risk management, and expect to make profits. To a certain degree, that is sort of the mathematical case. There's what's called terminal positive expectancy, right? As if you keep selling and you can survive the drawdowns or whatever, there is some money to be made. But the problem is you have to manage the risk, or you can basically blow your account up, right? But at the end of the day, that is the fundamental principle behind most, basically all option selling strategies.
But you're
There's
also
other
mentioning four types of edge in your podcast.
Yes. So there's kind of four fundamental ideas behind why an edge can exist. And so high level is one is informational edge. Basically, if you have some information that the general public doesn't, obviously we know insider trading, for example, is illegal, right? But if you are able to do some activity or have some connections or know something that the rest of the population doesn't, you can have an edge because you can act on that. Right now, that's very hard to come by. Right, most of us retail people, especially,
Mm.
you don't really expect to have informational edge. Now, there's analytical edge, which is you have the same information as everybody, but you're able to analyze or synthesize that information in a way that's novel or somebody else can't to produce some kind of signal. Now, that's also very difficult, right? Unless you have supercomputers or have some complex algorithms, I don't think most of us can, right? There's always someone smarter out there. So I don't know that you can expect to have analytical edge. Third one is technical or execution edge, right? Think about high frequency traders, right? Co-location. You can trade faster by a fraction of a millisecond, or you can execute or you do something, or even like if you have economies of scale and you have lower commission or you have lower slippage, right? Those are kind of technical ones where you squeeze out that profit margin. Once again, retail can't really compete on that front. So the last way of edge is basically behavioral or factors or kind of principles that are derived from behavioral biases. Um, we can connect that to volatility risk premium. Why is there risk premium? Why are options overpriced? Because of people who have fear or a need to, and they need to hedge their portfolio. Maybe they have some long equities, right? So they're willing to bid up the prices and buy these put options because they have a need to hedge their portfolio, or maybe they're just afraid of a crash or something, right? So have these kind of phenomena is derived from these behavioral biases. And one last thing I'll touch on is like people who believe in trend and momentum. It's similar, right? If people have FOMO, they're willing to chase a rally and keep buying, or if they have people have fear and they sell at the bottom, right? And why do markets react or overreact? It's because it kind of stem from these behavioral biases, and from those biases. And if you believe humans won't change and they haven't changed for eons, these behavioral biases can persist and can be the reason why you might have edge in a certain strategy.
So what you are saying is that us as a retail options trader, basically the edge we have is behavioral, and that's more specifically volatility risk premium.
Yes, I think we have the best chance of getting an edge from the result of behavioral biases. And I think volatility risk premium is kind of related and tied to these behavioral biases.
Your second principle, you called in your podcast, the volatility steals your edge. I would basically rephrase it to size correctly, if I understand this correctly. What is this about?
So, not to skip ahead, but I would actually say size correctly was more related to the third principle, which we'll get to. This volatility steals your edge is even more kind of insidious because it will sneak up on you. So, taken to an extreme, we've heard the phrase, for instance, if you lose half, like 50%, you need to double or gain 100% to get back to even. That's so-called that's the so-called volatility drag or volatility tax. Compounding is asymmetric, and negative compounding hits your account harder than positive compounding. Case in point, lose 50%, you need to gain 100%, right? Now, that's an extreme example, but my point is, even taken to the margins, right? If we go to the opposite, if you lose 1%, you probably have to only gain 1%. A little, it's in fact a little bit more. It's like 1.01%. But the
Mm.
point is, as your drawdowns get bigger, that tax or that asymmetry impacts your compounding more and more, to the point where you can have a strategy, right? So if you have a strategy that's 50-50 odds, 50% you make $1.10, 50% you lose $1. right? So 50-50, but when you win a little bit more. That's
Mm.
that's not great, but that's, if there's a coin like that, that's rigged, and you want to play that game, right? So and you flip that coin over and over. There's some positive expectancy, but let's say if we stretch that, right? 50% you make 5%, 50% you lose 5%. That actually starts to get to negative expectancy because that asymmetric compounding, as we described, will start. You won't, if you gain 5%, lose 5%, gain 5%, lose 5%, you're not getting back to even. That drag on that asymmetric compounding will slightly put you negative. So
Mm.
if you have a strategy that on the onset, right? Oh, I have 75% chance of making X, 25% chance of losing X. It might look like a nice expectancy, but if you trade bigger and bigger and bigger, right? Gaining 1% and losing 2% is not the same as gaining 10% and losing 20, or gaining 30 and losing 60. That variance drag or volatility drag will eventually dominate your expectancy. And you can have a strategy that might look positive actually
Mm.
become negative simply by the sizing getting bigger and bigger, all else constant.
And what's the tip to the trader to avoid this?
So, for one, just as a rule of thumb, like for instance, I try not to have a drawdown to my account more than 10%, for instance. But
Mm.
really, what you do is when you're doing back testing or setting up strategies, right? You can set up a certain strategy, run the test, and you look at the behavior, the equity curve, the drawdown, risk reward ratio, and then look at everything in terms of percentages, right? You don't, right? Having a strategy that like gain 1%, lose 2%, that's kind of reasonable. You don't want something that you gain 1%, lose 10% or 15%, right? So you look at
Mm.
all those, you look at the risk reward ratio, and then you look at the overall percentages, and you kind of determine, because once you've dialed in the size, okay, if I double my size, I
Mm.
generally should expect to make double. But
Mm.
again, with that variance drag in mind, if you have a strategy that's very asymmetric and you have to take a lot of risk, dialing up the size may counteract what you're intending, right? You think you're going to make double, but in fact, that variance drag may be kind of reducing your expected profit. So,
Mm.
what I want to say is basically you do your testing, you can kind of fine tune it and kind of observe the ranges of the variance in your equity curve and keep that within some reason where, again, you don't want to be losing 15, 20, 25% at any given time of your account.
Mm. Let's move to the third principle. Don't be a turkey. You headlined it in your podcast. What is this all about?
Yeah, this relates to this. That's a quote from Nassim Taleb, who of course wrote the famous "The Black Swan," and it has to
Mm.
do with black swans and unforeseen events, right? Because going back to the last one where we talk about sizing, it's important to size so there's no variance drag and just generally you don't have volatility. But you also have to keep in mind the unknown unknowns. You never know, like, right, the point of the term black swan is it's something unforeseen, right? So there can always be conditions or something outside your known sample set, like when you're back testing, for example. So if you think, oh, I have a stop loss, so I don't expect to lose more than X% or X dollars on this particular strategy at this size, but what if something happened, you couldn't stop out, or markets weren't functioning, or there's a big gap? You have to kind of think about, like, what would that loss look like in the extreme situation and
Mm.
size for that. But beyond that, the principle really is, if you size or do something where there is a chance of blowing up, you really have no alpha, right? You don't have a plan. If you can blow up, expect that you will. And relating to the "don't be a turkey," this has to do with the parable of the turkey, which is, turkeys are fed and they're raised on a farm. Every day is good, everything's fine, and then they think life is good until, oh, Thanksgiving, right? And suddenly their life ends, right? So that's what it relates to. Like, you don't want to be the turkey where everything's going well, and so you think it will continue and just kind of oblivious, because one
Mm.
day, if there's a chance that you can blow up, you will, right? So if there's a chance of ruin, you have no alpha. It doesn't matter how good the rest of the
Mm.
journey and the rest of your expectancy looks.
But does that mean we should also put up some kind of hedges as traders?
Yes. So I talk a lot about stop losses, for instance, in my podcast in the strategies. Now, those are kind of a active hedge. It's reactive, as in when something happens, you do something. Also, it's kind of the first line of defense. But once again, you have to imagine scenarios where you don't have control, right? Like a big gap, for instance. So, as a backstop, we also have black swan hedges, right? You can buy low delta teenies, right? Or low delta puts, for instance. Those kinds of hedges, it's just insurance, right? And you should, if you're gonna be serious about trading, you gotta treat it like a business, right? And businesses carry insurance, right? If you own a home,
Mm.
you have insurance. If you own a car, you have insurance. You have life insurance, right? So why wouldn't you try and have something? Insurance is just a way of risk management.
Mm.
And so again, at the end of the day, it's worth it to think about and consider some fixed cost that, yes, your returns are going to be reduced, but it's going to save your life, right, in
Mm.
an extreme scenario. And that goes back to the don't be a turkey. You need to do something to prevent becoming that turkey.
What type of strategies do you follow to hedge your positions?
We do kind of a mix. Some are just very naive, like I said, the traditional buy a one delta put 90 days
Mm.
and roll them. Some other ones I've talked about some other podcasts where we'll structure, like if we're selling a strangle, for instance, uh, we might do something more aggressive, like buy a straddle. And I've talked about in my other episodes where, yes, buying a straddle is kind of a nearer term. Buying structures that are actually nearer term than your options positions you're selling. Now, it sounds expensive at face value, but
Mm.
we've done the research. Sometimes, for instance, near the money or at the money options, they can be very volatile, but they may not be as overpriced as you think. And long term, you might lose a bunch in a certain time, you might make a bunch in a certain time, but after a long term, they come out pretty close to break even or actually not costing
Mm.
as much as you would expect. So
Mm.
we do various, option buying at different DTEs, at different deltas. And again, you just have to balance out. It's all a balance equation, right? You have to be willing to put a certain amount of your profits to the protection.
Mm. And this is to be considered an insurance cost rather than
It,
some strategy to make money on.
Exactly. Something to consider, like insurance, right? You never say, I'm gonna buy home insurance to make money, right? Or buy car
Mm.
insurance. Like you don't want it to make money, right? You don't want the accident to happen.
Mm.
So you just have to approach it with that same mindset.
I'm curious, what is kind of an acceptable cost, insurance cost for hedging your portfolio? Would you say 1% of your portfolio, 2, 3? You have a
So
guideline?
I would say it kind of relates to how aggressive you are with your returns, right? So if you're targeting 30% returns, right? I don't think 3% is that unreasonable, right? That's about a
Mm.
tenth of your profits, for instance. So I guess you can use that as a ballpark, right? Just in
Mm.
that realm, because like there's also been talks like if you have an equity portfolio, right? Let's just say you own stocks, right? And people might
Mm.
buy puts. You might spend 1, 2, 3% per year on the downside protection. So think of it
Mm.
as kind of a percentage of your profits,
Mm.
up to maybe 10% of your profits. Right? You don't want to go more than that because that's starting to really weigh in on things. But that should be kind of a yardstick for people to start
Mm.
thinking about.
And the fourth principle is think in components. What do you mean by that?
Yeah, so this is actually another way of saying first principle thinking. So a lot of times you do a strategy, you set up mechanics, and you're trying to fix a certain problem. Like, oh, the market did this, so I'm gonna do this specific mechanic or adjustment just for that problem. Or the market did that. But a lot of times, like you're gonna get fooled into doing something that's not really adding value. Right? If you're solving
mm,
this problem now, the market's always changing. So
mm,
don't expect the same problems to come up, or don't expect the same thing to fix all the problems. So thinking of components means stripping down the pieces of your strategy, not just your strategy. So a strategy is a set of mechanics, right? So you can look at
mm,
each mechanic, right? If I sell options, right? So we have a strategy called a theta engine, for instance, right? So we're selling 90 DT puts, right? 15 delta, for instance. There's a profit take and there's a stop loss, right? Those are very common things. But
mm,
in that strategy, I have a sell operation, which is selling the option. The profit take and the stop loss are both buy, because you have to buy to close, right? And they buy at a certain point, 60% profit or 2x stop loss or whatever it is. But you can actually, in your testing, or you have that list of transactions, you can even look at the sell transactions and the buy transactions separately and seeing,
mm,
are those making money? Are they, are they leaving money on the table? What exactly is it doing? And even more fundamentally, even trade structures, right? People know about an iron condor or an iron butterfly, right? You're the buying or selling the straddle or the strangle, and then you're buying or selling the wings. But
mm,
you can look at each leg of that structure, right? The components of it, and evaluate their value add or not. And so you can
mm,
distill down strategies and structures to their essence and try to find where, right? And that not only helps you find where the value is,
mm,
it helps you recognize different pieces of your strategy or structure have kind of different roles, and seeing how they interplay with each other. So it really
mm.
helps you understand, kind of, again, like, kind of from a first principles basis, like what's working and what's not. Why should this make money, or why shouldn't it?
Mm. So let's we've been through four principle. And I do recommend the viewers to actually listen to your full series of podcast episodes where you go much more in depth on all of this. But if you could just sum up in a few sentences what we've been through, what is the most key insight?
I think the most key insight is, again, having enough data and looking at what you do to understand why you should have profits, why you have a business model, right?
Mm,
Make money when you should, lose money when you should, as long as you understand and can rationalize what your P&L is doing in relationship to what the market's doing,
mm,
then things are going according to plan. If you're ever scratching your head and wondering, hey, why did this work, right? Then that's not good, right? Because you can't build conviction. And if you don't have
mm.
conviction, you can't execute. And conviction and consistent execution are the key to long-term success.
I have one final question for you because you are have been and are active in different retail trading communities. What is the most typical mistake retail traders make in your experience?
I think it's being too quick to make a change and react and not follow the rules. I think, like, I understand, like, when things are going not well, right?
Mhm,
Uh, you kind of panic or emotions come into play. And this is what I meant earlier about getting the wrong kind of feedback, right? Losing money does not necessarily mean you're not doing something right, right? So you
mm,
have to recognizing that losses and drawdowns are part of the process. And so you have to find or develop strategies and have an understanding and build a conviction to keep executing,
mm,
uh, and not just strategy hop or panic or change size at the wrong time. And, oh, I'm losing money, I'm going to size down. Of course, you always size down when the strategy is recovering, and vice versa. So
mm.
it's to be data driven and not so reactionary to your emotions.
Thank you. How do people get in touch with you, and what communities are you active in?
Yeah, so we have our own Discord group. It's for podcast listeners. That just means, we like people that actually have an interest to be engaged and at least follow some of my content. So if you're interested in that, uh, my trading page, which lists all the podcast episodes, has a lot of other content, and also lists the email address, is thetradebusters.com. And note that that URL will just redirect you. It's actually a Google Sheets page that I set up like years ago, but it has all of the links and information. Um, if you're on Twitter or X, you can follow me at the Trade Buster. So the Trade Buster without the S at the end, but that's my handle on X. So feel free to shoot me a DM or email. I'm looking forward to connecting with more people.
David, thank you very much for joining. I really appreciate you sharing your insights with our viewers.
Thank you, John. It was a pleasure.